bottom line of this equation prices gold at around plus or minus $4,000, much as these physical facing liquidity providers did when they were relaying their minimum 3,000 target prior valuations when gold was trading in the low 2000s, all the way back in March of 2024, into this relentless Asia buys physical, West sells paper gold, de-dollarizing process. The resulting volatile clash of US-centric paper gold hitting central bank-derived physical market support levels has resulted in the constructive process of regularly ejecting speculative US-centric gold froth, enabling higher physical supported stair steps to be forged. We've looked at that so often along the way.
Gold market volatility in 2025 has reached unprecedented levels, with price fluctuations as significant as $360 within just 2 weeks. Despite these dramatic shifts, gold has posted a strong 26% gain year-to-date, highlighting its increasingly important role amidst global structural and geopolitical changes. The growing disconnects between paper gold derivatives, such as COMEX futures, and the physical gold market is a key factor driving this volatility. Paper gold allows for speculative trading with minimal margin requirements, while physical gold, underpinned by Basel III regulations, demands full backing and strict settlement protocols. This disconnect has led to discrepancies in price discovery, where short-term market movements are not always aligned with physical demand. Implementing Basel III regulations has further accelerated this shift, forcing a realignment of gold market fundamentals. By designating gold as a Tier 1 asset and requiring positions to be fully backed, Basel III moves gold trading away from speculative practices and into a more stable, asset-backed framework. While many global markets have already adopted these standards, the US market has lagged behind. This delay has allowed arbitrage opportunities to distort prices, increasing market volatility. However, once compliance is achieved, leverage is expected to be reduced, transparency will increase, and the link between gold prices and physical holdings will be strengthened. These changes have wide-ranging implications for investors and policymakers alike. As global financial systems move toward de-dollarization, countries, particularly in the BRICS and Asia, are increasing their gold reserves. This trend emphasizes gold's strategic importance as a hedge against currency risks and systemic instability. Andrew Maguire predicts that investors may soon see a significant upward revaluation of gold, with some projections suggesting prices could reach between $4,000 and $5,400 per ounce. For policymakers, gold's evolving role within global reserves and its growing prominence as a monetary tool will require careful consideration. Now, let's look at Andrew's insights from his recent interview on predicting the actual value of gold and silver in today's uncertain economic climate. Before we continue, please subscribe to our channel and activate the bell icon to stay updated with our latest content. Thank you, and enjoy the video now.
As we have just witnessed in this period we're now delving into, it regularly sets up the COMEX casino pit managers for both an upside and a downside two-way rinse into which they control. Now, the lion's share of non-Basel III compliant US-facing CTA investments are populated in the gold exchange traded funds. We've done lots and lots of reports about how they work, how they're not one-to-one backed, etc., etc. But they track the gold price. So that's really what these funds are doing. And that being the case, as far as these funds' balance sheets are concerned, namely which are the cashable assets required to be funded against their liabilities, simple, these funds have to treat gold as another tradable, high-quality liquid asset, but it's like any other commodity which employs a required stable funding, a discount of 85%. So in other words, it's discounted. So it's only, it can only be valued at 85% of what is shown. And as we've been drawing frequent attention to, unlike every other global facing exchange, these US facing leveraged gold positions are not Basel III compliant. In other words, due to this balance sheet haircut, ETF gold investments don't qualify as a first-year asset that can be one-to-one exchange for physical gold or cash. Big difference. Unlike global liquidity providers servicing the non-stable funding, the net stable funding compliant foreign exchange markets, who, if they are called upon for delivery, must one-to-one deliver spot gold at the benchmark fixed prices on a T+1, a one-day basis, whereas the US-facing CTAs have to apply a discount to the gold they hold in the gold futures or related ETF long position. Now, by design, aside from generally disincentivizing non-yield bearing gold as an investment alternative for these traders, rather letting them chase after stocks and higher risk asset classes, it sets these investors up for a regular bid-pulled COMEX rinses. Now, bid-pulled in the sense that no bullion bank, nor even the Fed, wants to expose themselves to adding short positions they cannot offset against these speculators. They're not stupid. I mean, China's taking everything that's on offer, as are BRICS banks. So, however, as far as Basel III global NSFR compliant deliverable FX market making bullion banks are concerned, they must one-to-one have the bullion on hand to deliver when called on to do so at a benchmark spot fix, where foreign central banks, sovereigns, institutional buyers are one-to-one able to exchange their respective FX currencies for an equal weight of bullion without any discount. The paper to physical disparity, this paper to physical disparity sets up the regular wash and rinse cycles where an NSFR compliant bullion bank can gain a balance sheet advantage against these non-physical holders. The Bank of International Settlements enables a zero risk weight to these bullion banks' gold positions. And I will stress physical gold held at the bank or held in another bank on an allocated basis. In other words, it all interconnects. And bottom line, to the extent that gold bullion assets are backed by gold bullion liabilities, Basel III compliance enables gold to qualify as both a high quality liquid asset and a first year asset class that competes with US Treasuries as an asset class. Hence, why we see global pension funds, and includes ramp up in Chinese insurance funds, etc., one-to-one, and bullion banks, one-to-one exchanging treasuries for physical bullion without any haircut. And as we know, every single market-making CME and LBMA-facing bullion bank has a straddle footprint in both the NSFR-compliant physically deliverable 10 times larger foreign exchange markets and the as yet non-NSFR compliant CME markets, which are heavily leveraged. And that is the equation. Our well-connected liquidity providers affirm that this US-centric haircut will have to end on the 1st of July. And here's the kicker. If it doesn't match the 10 times larger spot gold FX market price at the benchmark global gold fix, then the backdoor exchange for physical mechanism, we've talked about it as the Achilles heel, this where it's possible to convert a non-compliant COMEX lot into NSFR compliant T+1 deliverable foreign exchange gold, it's going to explode, alchemizing what little dwindling underpriced COMEX open interest there is. Now, given the OCC bets sit on the Fed's balance sheet and are likely interconnected with rehypothecated US Treasury gold positions, we should never count out these actors. So I never count out one more spec wrong-footed flash rinse. So if anyone is heavily leveraged, please be careful over the next 2 weeks. In fact, over the next week. Now, if you're a stacker, then join the Asian buyers in taking what's on offer, especially at the end of each month, as we've just witnessed, into this discount. But we see attempts to try and trick technical traders into selling. So I would not rule out a flash $100 move lower into spot 3,200. I wouldn't rule it out. But if this was offered, it would run into massive reported central bank bids populated there. I really don't think there's enough spec open interest available to do that. But short-term volatility aside, what is being missed by many US-centric traders is that the COMEX is rapidly losing pricing power, and they are in the crosshairs of a physically driven global price reset.
As global tensions rise, the strategic importance of gold in the financial system has become increasingly evident, especially with China's recent moves in the gold market. The shift from a dollar-dominated world to one where gold plays a central role is becoming more apparent. China has taken deliberate steps to position itself as the leader in this new system, including opening its domestic gold futures market to international participants and developing infrastructure for global gold settlement. According to renowned analyst Andrew Maguire, the true extent of China's gold holdings, likely much larger than officially disclosed, could be a game-changer if revealed, significantly impacting the balance of power in global finance. In addition to its growing dominance in the gold market, China is advancing the use of the digital renminbi as part of its strategy to reduce reliance on the US dollar. This is not just about gold-backed payments within BRICS nations, but also extends to a broader network. As Maguire points out, these nations are already facilitating trade worth 38% of global trade, bypassing the US-controlled SWIFT payment system. The push for a gold-backed digital currency is likely to expand rapidly, providing a powerful alternative to the dollar and further accelerating the de-dollarization trend. These moves, largely ignored by mainstream media, are setting the stage for a major realignment in the global economic order.
China is openly talking gold higher. It's so obvious. And it used to be hidden, used to be stealthy, no longer. Following Trump's comment, he said, "Who has the gold makes the rules." Well, that was a tweet. Now, if the financial war does escalate and or a military war ensues, and that is plausible, even if it's a proxy war, Trump's comments may grossly backfire. China's nuclear option would be to reveal the real extent of their unencumbered PBOC gold holdings, dwarfing the unaudited, likely rehypothecated US Treasury gold holdings. And as we discussed in detail last time, and still missed by the mainstream media, I haven't seen it anywhere with other market commentators. As the US-China trade war risks escalating into a once-in-a-century financial war, China's anchored BRICS payment chains are rapidly onshoring, providing sufficient liquidity to also digitize. And as we talked about it last time, I re-raised it. Glasgow fully beta-tested BRICS-facing gold-backed commodity currency. Now, our Asian liquidity providers figure this will ultimately result in a global gold price quoted in RMB, because that is where the main links are, forcing the local London AM and PM dollar fixes to quote these prices ultimately. This is very big news. It means de-dollarization in a big way. It will completely reset the world order. So step by step, China is really revealing its very strong hand, following opening up gold futures trading to Chinese citizens and institutionals. We've looked at it multiple times. On the 1st of March, exactly 6 months later, in October, the PBOC opened up foreign firms to be able to trade industrial metals on the Shanghai Futures Exchange, undermining the pricing power of the LME. Now, exactly 6 months later, and 1 year after opening up the Shanghai Futures Exchange gold futures trading domestically, the PBOC is moving to open up Shanghai gold market overseas warehouses to enable gold settlement of gold and silver and platinum, shifting the market sway from the West to China. This is the final leg of them putting this whole strategy together. Trump has attempted to push back. One phone call and they'll be back on the dollar is what he said. However, look, with the dollar already weaponized against China, Russia, and Iran, and given that the sudden expansion of tariffs equals sanctions, and these nations control the lion's share of global commodities, the US has very little additional leverage over China and Russia's expansion of their alternate non-dollar settlements. And to sum up, what we're witnessing is a major de-dollarization move that is seemingly or probably deliberately ignored by the mainstream media and official channels. Maybe they don't understand it. It's being ignored that the PBOC announced its digital RMB, and it's already been connected to, this is why it's amazing that it's ignored. It's been connected to 10 Asian and 6 Middle Eastern countries. That's already facilitating 38% of global trade that is able to bypass the weaponized SWIFT payment chain. Unbelievable this is ignored. And while the United States is still debating whether digital currencies threaten the status of the US dollar, which they don't, in my view, 87% of nations, that's 200 countries, have already adopted the digital RMB. Cross-border payments have already exceeded 1.4 trillion US dollars and growing. And while the scope of RMB settlements are limited, they are growing. However, add in the ability to digitize Glazjev's gold-backed stablecoin as a 7-second ruble settlement currency, these volumes are about to exponentially explode. These are the liquid payment rails that Glazjev beta-tested gold-backed currency. And remember, we talked about that beta testing. That's 2 years ago. And then we saw this failure at the BRICS summit to employ anything. It made a great deal of sense, perhaps not to deploy it at that time. But it's going to facilitate BRICS members, nations who trade, as I say, 85% of global commodities that they produce or consume amongst themselves. So to have a gold-backed currency. Lavrov has also promised access to alternative payment platforms for non-BRICS members. So this is being opened up for non-BRICS members too, referring to the financial messaging system of the Bank of Russia. Now, the digital RMB BRICS payment bridge is not only a multinodal, multipolar global payment tool, but also a technical carrier of the Belt and Road strategy. It enables the build out of the digital Silk Road, and it provides access to the Northern Sea route in instant settlement. And all of these moves are part of a strategic plan for China to stick handle BRICS nations to become one global benchmark price setters for all commodities, revealing the PBOC has taken its kids' gloves off, along with Russia, are now in a position to consolidate these BRICS-centric markets.
Gold market volatility reflects the early stages of a multipolar financial system as paper and physical markets converge under Basel III regulations. Gold's dual role as both a monetary asset and a geopolitical tool is becoming clearer, with its significance growing in the face of shifting global financial structures. Investors must move past short-term market noise and recognize that strategic accumulation of physical gold is a key way to protect wealth against future systemic shocks. Understanding the broader context, such as the emerging commodity supercycle, is essential to grasp gold's evolving place in the global economy. As Andrew Maguire states, "To protect your wealth, how much physical gold and silver do you own right now?" A question that will shape future financial resilience. The rise of alternative currencies and the rapid growth of non-dollar payment systems further emphasize the importance of tangible assets like gold in safeguarding wealth. Do you agree with Andrew's prediction of gold and silver prices? Share your thoughts in the comment section below. If you found this message compelling and enjoyed the video, be sure to give it a thumbs up, share it with others, subscribe to our channel, and turn on post notifications for more thought-provoking content. Thanks for watching.